Welcome to the Wealth Acceleration Podcast with your host, Wealth Coach Wade Reed.
Hey, what's up, Money Masters? It's Wade Reed here for another episode of the Wealth Acceleration Podcast. We are continuing our topic of the family bank strategy, and today I want to bring some really practical applications. So I have a guest with me. His name's Justin Southall. Justin, welcome.
Thanks for having me, Wade. Appreciate it.
You're welcome. Guys, the relationship I have with Justin has been since December 2016. So we're going on 8 years almost, and Justin and I have just connected. We have similar family dynamics. We're small business owners. Had a lot of interesting conversations over the years about money and the different practical things that come up, from car purchases to debt repayment to commercial building purchases of lot and building and developing the land into a building, and many, many other things. So, Justin, if you don't mind, tell us a little bit about yourself, your family, your business, and let's just go from there.
Okay. I'm Dr. Justin Southall. I have 2 chiropractic clinics in the state of Alabama. I've got a wife and 3 kids. I've got a 17-year-old boy, 14-year-old boy, and a 12-year-old little girl. We decided to move to Alabama in 2009 after a couple years in Baton Rouge of practicing a different sort of chiropractic that I didn't love. And we ended up finding Fairhope, Alabama, and falling in love. So we started our practice in the very beginning of 2010, grew it. 2017, I decided to open a second clinic across the bay from us, about 30 minutes. And as we did that, we started growing even more. And then we got into where we needed to build a building, and it's just taken off.
Awesome. What is it about chiropractic that got you interested?
So when I was 16, into my sophomore year in high school, I was big into sports, thought I was going to play college football. Actually had offers to play at West Virginia and Duke. And that summer I was at VMI basketball camp with my team and sprained my ankle really bad. And that week I had no access to any trainers or anything like that because I was way far away from where my parents were. So got back home and my mom said, I'm going to take you to your athletic trainer. That was our team trainer. I was an 8th grader. And so here I am getting ready to be a junior, can't walk, sprained ankle, all swollen up, walking to this chiropractic clinic called Worldwide Chiropractic and Sports Medicine. And I was going for the sports medicine, knew nothing about chiropractic. And I walk in and athletic trainer's right there, and she greets me and she's like, oh my gosh, you got to meet our chiropractor. And so he is Bon Jovi's chiropractor. He ends up also traveling with Guns N' Roses. He is also an Olympic trials pole vaulter. And he said, you're a pole vaulter. And I'm like, what? We don't even have pole vault. Yeah, very odd. And he was like, how fast are you? How tall are you? He was just quizzing me like crazy. And he just knew from my frame that I was a pole vaulter. And so he said, I'm going to turn you into a state champion. And I was like, sure you are. Calling my coach. I'm like, hey, coach, we got to have pole vaulting pit. And he was like, why? He was like, we hadn't had a pole vaulter in years. And I said, well, I'm going to win states this year. And he was like, who's going to coach you? I said, this chiropractor. So long story short, I win states 2 years in a row, get a full ride Division I track and field for pole vaulting, and decided to do that over football, which was a good decision. And sometimes I regret it when I'm watching Saturday college football, but it was a free ride and I couldn't pass that up at the time. So while in track and field, chronic injuries, ended up going from just being a pole vaulter to a decathlete, and decathletes stay chronically injured because of all the overuse in training, and the athletic trainers, the medical doctors, all the staff there at the school was just not being able to help me. I had a hamstring or groin injury, and it was always like, here, take this Celebrex or this and that. Mm-hmm. So ended up going back to my chiropractor. He would fix me up. I'd come back healthy, train until overuse injury happened again, and then go through that same process. And so then I tore my ACL. And after the surgery, I came back for spring break and rehabbed it at his clinic because I was back home and that was the only place to do it in town. And came back the week after rehabbing and saw the surgeon. And he's like, your knee's amazing. What have you been doing? I was like, oh my gosh, I've been going to my chiropractor. He's like, that's awesome. So my plan was going to be an orthopedic surgeon, but after seeing the results that I was getting with this chiropractor, I go back home and having a conversation with him. I was like, I'm just a little discouraged with orthopedic. I don't know which route I want to go. And he said, why haven't you thought about chiropractic? You've lived in here. We've helped you. You perform better. And so that got me started in the chiropractic world.
So it sounds like the experience of chiropractic isn't just about neck and spine, but extremities as well?
No. That's right.
Is that right?
That's right. So our clinic here in Fairhope, where I was practicing a different style in Baton Rouge. Baton Rouge, we were mainly treating pain and car accident patients, and it just didn't fit my persona. I still treat it here occasionally. We may have, 5% of our patients that do that, and most of them are patients that we've already treated. But we specialize in soft tissue injuries, sports injuries, fascia, things like that the average chiropractor doesn't do.
Wow. I remember that you were in sports medicine. I didn't quite get the extent to which, I guess it's been a while since we've talked about it, but wow, that's pretty incredible.
It's fun.
So you guys get a lot of good results similar to what you got for your same patients.
Yes, absolutely. I would say 80+% of our patients get well with the techniques we do, when on average it's 50 to 60% in the profession.
Wow. So I bet you feel really fulfilled in the work you're doing.
I do. Occasionally I wish I could still be a surgeon when I'm in the hospital, but
yeah,
that doesn't happen very
often. So let's transition to the family bank strategy. So as I recall, when we first met, again, this is December 2016, my notes reflect, and you had already set up a whole life insurance policy. Tell us what got you into the idea of having a whole life policy in the first place.
So we opened our clinic here in 2010, and after a year or two, we were starting to make some profit, and I was trying to figure out how I'm going to set up this retirement for my family. So I met with an advisor, and of course, they wanted me to get an IRA and start putting $11,000 into that. And then we have a diversified stocks and bonds, and I just wasn't seeing the results that I wanted. And I still had this, my wife's a chiropractor as well. So we still had her $162,000 chiropractic loan, and we had my $158,000 chiropractic loan, and it wasn't budging. Without me making huge debt down payments, just chunking it away, and I just didn't feel comfortable with it because I just didn't know what to do. There was a chiropractor that I listened to on podcast, and he talked about debt reduction, how to pay off your loans. And I was like, okay, you got me hooked. So I listened to it, and this particular guy had paid off like over $1 million in loans, including his clinic building and all that, within a couple years. And it really struck some good interest. So I spoke with him, learned from him, still didn't buy into the whole life policy because I was still trying to understand the concept, because for a lot of people it's difficult to understand. So from there, I bought a book, actually Nelson Nash's book. Then I read another book that Dwayne Burnell wrote, and that helped me understand it a lot more. And once I grasped that concept, we started our first two policies with Toby and my wife and myself.
So it was all about, what was the concept though? There was this desire to pay down debt. Okay, yep. So the whole idea was, how do we somehow use a whole life policy to help with debt repayment?
That's right.
The concept, okay? Tell us more about how that became a practical thing. How could that work to have a policy that helps pay down debt? So
I was already paying debt, right? I was already paying these loans every month. I was already paying my car, my wife's car. I was paying our student loans, which was several $1,000s a month. And the first thing we did, I think my policy was $60,000 a year. It was like $24,000 premium, and then I would put in an extra $36,000 a year. And so the very first thing I did was I paid off. I took the loan I had on my car. I paid the policy. I pulled the money from the policy, which I took a loan from, and I paid my car off and my wife's car. And then what I was already paying towards that, I paid back into the policy each month. So I was basically paying that back. And when I'm taking that loan, that policy just continues to grow at that typically 4% rate, plus your dividends.
Yeah.
That was the first thing I did. And I was kind of just testing the waters. I know 60,000 is a lot to test the waters, but I felt comfortable from all the research I did that I knew this, I was going to be in it for a long-term process, and that long-term process was going to give me the financial future and the retirement security that I was looking for.
Yeah. Well, let's break that down a little bit better, or perhaps more clearly. You bought a whole life policy that had the ability to hold $60,000 a year. Part of that, you said $24,000 was the premium. That's often what we call the base premium. And then this other $36,000 that goes into what's called the paid up addition rider, and that's what builds the cash value quickly in the policy. So you had enough savings that you could actually fund that quickly, perhaps in a lump sum, and then immediately take a loan against the policy. So now all $60,000 is in the policy. You're taking a loan for what you need to pay off the car, and then you pay off the car loan. In essence, you refinance the car. That's really what's happening. Is you're refinancing the car from the bank to yourself through the policy. And then you take the same payment you were making to the bank, and instead you take that payment and you replenish the loan you took against the policy. And now you have more control over your debt. You're not forced to make a principal and interest payment to the bank. Instead, you have the freedom to pay back the loan at your preference. We want to do at least what we were doing, but if you had a tough moment, you could stop doing that for a while. So you have more control over it.
That's correct.
And guys, what's really cool about the whole life is the money that gets in the policy is used as collateral, meaning that like the car that you had a loan on it, you still have the car in all its use, even though you had a loan against it. All of us who are homeowners have loans against our houses, and those appreciate in value, and we have full use of the house, but it also has a loan against it. In just the same way, a life insurance policy can have a loan against it, and it continues to grow in value, and we have full use of it. In the event of death, of course, the death benefit pays out. The cash value that builds up in there grows, even though we've got a loan against it. So we have this compounding positive growth while we have the accessibility of the money to go do these larger purchases, like paying off a car or buying a new car, and then financing it yourself rather than going through a traditional bank.
That's correct.
So that's one of the most practical use cases of whole life insurance is those reasonably priced car purchases, $15,000 to $50,000, depending on what you get. And then fast forward, I remember looking at that plan that Dwayne Burnell had put together for you, and it included paying off the student loans as well.
That was the biggest thing. So we started that policy in 2015. I believe it was 17, maybe 18. We had then been able to keep funding it. And we had enough money to pay off the student loan. And I remember the very day my wife and I were flying out to a seminar. Actually, we were flying out to the Wealth Factory seminar that we did. That's where we met you. So that was only fast forward a year. Yeah, that was a fast forward a year, because I remember us sitting in the parking lot, and I made the call to the student loan department and got my payoff, and right there on the phone paid it off utilizing the policy, and it was like happy dance. My wife was so excited, and so were we. That was just this giant gorilla on my back for years. I graduated in 2007, and I was like, I am never going to pay this massive amount of student loan debt away. I'm never going to pay it off. And so we paid it off using the policy and started paying that back towards the policy. And then within just a couple of years, it was truly all gone, and all of money is back into the policy.
Right on. So I get the question a lot of, what do we do first? Savings, debt repayment, investing in retirement plans. And the answer with the family bank strategy, with the use of whole life insurance policies that are specifically structured for high cash value quickly, often what we call high early cash value, is this ability to take control over your long-term savings, which is in your name. It's private. It doesn't have any government controls over it. And so when you choose to use it, it acts like cash. You refinance the student loan into the policy, and now again you have the control over the amount of payment. You can accelerate it, you can do it slowly. If you have a lump sum come in from a windfall of a good month in business, or maybe you're flipping a real estate property, or you get an inheritance, you can just funnel that money into the policy. And so you're able to save, protect in case of early death, have tax advantaged growth, tax-free access. And eventually, like we can talk about this as a retirement income source as well, it can be a tax-free retirement income source for us.
That's it.
So you accomplish two major things that virtually all my clients have been dealing with, which is student loan repayment and car payoff. And then, of course, there's things that become more interesting, like business growth and maybe real estate for your business. Let's talk a little bit about what you've done with the policy to support those things.
So in 2018, 19, we started looking to expand out of our clinic. We were in 2,500 square feet, and we were definitely outgrowing the place, but locally I couldn't find a place to build and searched forever. And finally, this random vacant lot showed up that was kind of wooded. No one really knew it was available, and it was literally a block and a half, 2 blocks from our other clinic. And so we were able to make an offer on it pretty quick, and I was able to pull from the policy without needing to go through a bank or anything and waiting for the delays and all that, and make a cash offer with that, which was huge because the seller was very interested in not having to have any delays or anything like that. In conjunction with that, we were able to buy a full acre, and that allowed us to put 2 buildings on it, and we're able to have a lease tenant in one of the buildings, as well as using our clinic in the other building. And then we were able to structure separate LLCs, do different things like that. But the whole time we were able to be putting the money back into that policy through the repayment.
And through rents, right, that you were paying and your tenants were paying.
Yeah, through rent. Yeah. Through rent. Yep. And
so guys, I just love this concept of when you're in a position of cash, opportunities seek you out. When you're in a position of cash, opportunities come to you. You had put yourself in a position of cash, both bank accounts and in their whole life policies. And when this opportunity showed up of land that you got to snatch up quickly because you were in that position of cash and didn't go have to get a loan, you were able to acquire land at a discount that was perfect for what your needs were. And I remember when we first talked about this, you were thinking about just a single building, and some other mentor in your life said, well, if you're going to do one, you might as well do 2. And you're like, oh, I suppose I could think a little bigger than I was originally thinking. So you did that. I think you got a 10-year lease on that second building for a tenant.
10-year lease. He's paying $6,000 a month to me.
Yeah.
So do the math on that.
You've got your space that you needed that was bigger than what you currently had, and I think you had another tenant in that same building that you're in.
Yep.
Is that right?
We did.
Yeah. So you've got rents you're paying yourself.
And so here we are again with the opportunity, and Wade and I just talked a few days ago, but here we are again with another chance to purchase a almost acre lot for our second clinic that we opened up. Just within days, I have 2 possible extra tenants, PT and an athletic trainer, that both are like, hey, I want to join you guys. And so if possible, I'm going to potentially have 2 extra tenants helping pay down that mortgage.
So there's power in the compounding effect of money. You start an asset. The asset that we first start is ourselves and our knowledge base. And then we apply that to employment or to business. In your case, you chose to be in business for yourself as a chiropractor, offering a specialized skill set in servicing athletes, and that's produced very healthy income for you and your family. Applying that income and not just spending it all, but setting it aside purposefully using the whole life policies and then allowing that cash that's built up in there to give you a chance to make careful decisions about these expansion activities, the second clinic, the office buildings that you built. And now that you're in a position of cash again, I know it kind of wore you out to do those buildings. So sometimes we buy assets, we get them stabilized, we kind of go through the difficulties of those types of bigger projects. We take a breather, then we kind of get ready to do another one. So you're kind of on the cusp of this second round of development of a building that will add not only the value of the asset and the rents that come in, but there's other tax advantages of owning real estate. So a lot of my listeners, I know you guys are thinking about what kind of real estate ventures can I be involved in? Well, developing your own building is quite extensive and challenging. So you may or may not choose to do that. But a lot of the doctors I work with are wanting to do something like that. You get this accelerated depreciation on that building. And depreciation is one of those powerful tax advantages because it's a paper transaction, but it's real. It like reduces your taxes dramatically. So when you build a building, you can accelerate its depreciation based on tax law called a cost segregation study. And then like the costs of building that are recovered pretty quickly. You get the cash back in terms of tax savings to help replenish the coffers. And then the building becomes self-sustaining through the rents that are being paid into it. So it's a pretty exciting time. We're seeing what I said before, the compounding effect of adding assets on assets, and the pile is getting bigger. And as the pile is bigger, then the total growth is exponentially bigger. Right?
Absolutely.
This is, and it's not just about money in a savings account. It's about the practical application of what assets you choose to purchase. If you just stay in the stock market and experience the ups and downs there, it can be really devastating and really exciting. But there's not a lot of progress. We've got to do other more interesting things like, I don't know, I can't say it better than just buying assets that can produce cash flow for you and tax advantages where possible. So there's a little bit of a conundrum we were talking about before we started recording here. You've got this second home that you guys built, this dream lake house, because you guys love to be on the lake as a family. And so you found a property, you built that up. How did you fund that?
So basically using the cash value that we have through the policies, we did join with Coastal States Bank and do a cash value line of credit where I'm able to pull from it at any time using the cash values of my policy. And so we were able to build this $800,000 lake house. I bought the lot initially and then built the lake house and never once talked to a bank. The builder was like, I'm going to need to see some bank stuff. I'm like, well, I'm the banker and I'm paying you cash. And he didn't ask any more questions. The only thing I said, give me, anywhere from 72 hours to a week if you need a deposit or a drawdown. Mm-hmm. And so he was good with that. And it was very simple, utilizing the policy. I'm paying back what I would be paying a typical mortgage for that lake house, but I don't have that debt sitting on some bank's note right now or affecting my credit at all.
Yeah, so again, being in a position of cash, what's interesting about what you just said, the Coastal States Bank, they're a banking institution that specializes, at least in part, on recognizing that whole life policies are assets, and thereby they can be collateralized. So not only did you have the policies that you set up with the other agent, but in 2020, you and I worked together on setting up some additional policies for you and your wife. And then you've got 4 life insurance policies. Well, generally, if you need access to a policy, you have to go to each individual policy and request a loan from each of them. But what Coastal States Bank and what some other institutions will do is collateralize all 4 of them together into a single line of credit. So for those of you out there listening who might have multiple policies and have a significant amount of cash value built up in there, that's something you might look into as a single line of credit with an external bank to offer simpler access to those policy cash values through a single line of credit. And so you utilized that to get this lake house. And now as you're considering the land purchase for the possible building to be built for the second clinic, now this question came up, well, does it make sense to get an actual mortgage on that lake house, repay some of the line of credit against the cash value, and then have more liquidity to work on this next project? So walk us through that thought process and possibilities?
Well, my thought process on this was currently second home interest rates about 6.25 with good credit, which we have. And that's what I'm kind of paying into the cash value line of credit from the amount that I've drawn out. But a business or commercial loan is typically higher than a second home. And luckily, this building that I'm sitting in right now, we were able to lock it in at 4% in 2020 when COVID hit and all the rates were crazy. I think a home mortgage was at 2.25, 2.5. That's what my mortgage is at my house. It's at 2.5. So I have no desire to go rid of that debt because 2.5% is nothing.
Mm-hmm.
So if I have to finance this building, that's going to be 1.5 to 2 million for the next clinic. I don't want an interest rate above 6.25%. And that's what the commercial loan is probably going to be 7, 8, 9, 10%. And that makes a $1.5 million project a $14,000, $15,000 a month payment. And that's more than I want to pay.
Yeah. So we're considering then, what do we do to kind of reorganize the financial cash position? And your line of credit's at about 6.25. You can get a mortgage at 6.25. We can lock in a 30-year mortgage to keep the cash flow cost on that second house mortgage really low, freeing up a bunch of cash flow that was otherwise going into repaying the line of credit, which then that lump sum from the mortgage can go to repay the line of credit, which frees up a bunch of available cash that then can allow you to incrementally pay toward that building project. And maybe we're going to see lower rates in the next 6 months to a year as this project gets moving. And then you can lock in, when the timing's right, a commercial mortgage on that building, anywhere from 15 to 25 years, depending on if you're using a traditional bank or maybe SBA financing. And so it buys us options, guys. Using policies like this buys us options to shift things back and forth. If we manage things well, we can choose the type of lending, whether it's commercial lending or whether it's mortgage lending or a bank loan versus a life insurance loan. In all these cases, though, the intention is to be proactive and acquire assets while maintaining a healthy cash flow. So guys, I don't know if you remember me talking about this in prior episodes, but I'll just remind you, there's three pillars to personal finance. It's cash flow, protection, and wealth creation. So we're working on cash flow through these possible discussions of refinancing the loans. We're looking at wealth building by acquiring assets, and we're looking at protecting by having the life insurance in place, which also, as a side note, money that's in the policy as cash value is protected against lawsuit and bankruptcy. So if you got into a tough situation as a business owner or a situation with a tenant and they sued you, the money that's in your policies is protected. Whereas if it was just in the bank, it would be available. So we add what we call asset protection in there, as well as the income protection from the death benefit itself. All right, Justin, really appreciate your time today and your open
Thanks for having me.
Discussion, man. It's so cool to see the real practical applications of this family bank strategy. We didn't really get into the long term, but being in your early 40s, you've got 20, 30 years before a formal retirement might happen. And over that period of time, you're going to have a substantial amount that's available as a tax-free income, in addition to the cash flows from your business and real estate ventures. So guys, if you have any desire, if you happen to be a chiropractor or need chiropractic services, he's in Fairhope, Alabama, incredible clinic. I know he's open to sharing ideas with other chiropractors. Let me know. I can help connect you guys. If you have a desire to connect about this whole life policies, I'm happy to support you. Reach out and we'll get some time scheduled. Thanks for listening. Like, subscribe, and please leave comments in the YouTube page. Leave us a review. I love you guys, and we'll see you in the next episode.
Thanks for tuning in to the Wealth Acceleration Podcast. We hope the insights from today's episode help you streamline your finances and grow your wealth stress-free. For show notes from today's episode and more tips on creating a comprehensive wealth-building plan, visit moneymasterycoaching.com. Remember, financial freedom is attainable. Until next time, keep accelerating towards your goals. See you on the next episode.